Artificial intelligence has always carried an air of inevitability. For decades, scientists predicted that one day machines would learn, reason, and create. But what no one fully anticipated was the speed at which the world would pivot once AI seemed not just possible, but profitable. In late 2022, after the public release of breakthrough generative systems, AI stopped being a distant concept and became the defining economic force of the decade. Capital poured in, valuations surged, and companies began restructuring themselves around the promise of a technology still in its early adolescence. But beneath the excitement, something else was forming. A bubble. Quiet at first, then unmistakable. One built not only on innovation, but on speculation, hype, and the belief that unlimited growth could be engineered out of thin air. This is the story of how we got here, why the world is repeating a familiar pattern, and what happens when expectations outpace reality. The roots of the AI boom begin in the cost curves. Training a frontier model today requires tens of thousands of GPUs and hundreds of millions of dollars. The world's largest models now cost over $1 billion to train, and some analysts predict we will see multi-billion-dollar training runs by 2026. These numbers are real, verifiable, and staggering. But they also create a pressure that almost guarantees a bubble. The companies spending this much need an enormous return to justify the investment. Investors love exponential curves, and AI offers them everywhere. User adoption of generative tools reached 100 million monthly active users faster than any technology in history. Nvidia's market cap passed $3 trillion. Over 60% of S&P 500 earnings calls referenced AI. Meanwhile, private AI startups raised more money in 18 months than during the entire 2010 to 2020 decade. Money didn't just flow into AI, it flooded into it. But exponential hype often hides linear reality. While AI is unquestionably transformative, its economic impact is slower and messier than investors want to believe. Productivity gains remain hard to measure. Many corporate AI initiatives generate little revenue, and despite massive investments, practical deployment outside tech and finance remains limited. The gap between promise and execution widens each quarter. Then there is the infrastructure problem. The world is running out of GPUs, running out of data center power, and, in some regions, literally running out of electricity. Analysts now forecast a 30 gigawatt data center shortage by 2027, a deficit larger than the power consumption of some countries. Momentum continues, but constraints tighten. You cannot scale infinitely on finite energy. These are not signs of failure. They are signs of a bubble forming around a real technology. Just like the dot-com boom, AI is revolutionary. But revolutions do not eliminate economic cycles. They accelerate them. Still, optimism reigns. Markets believe AI will reshape everything: healthcare, logistics, media, defense, education, and finance. And maybe it will. But the gap between belief and current capability grows wider each month. In that gap, speculation thrives. Once AI became the world's most valuable narrative, every company needed to attach itself to the story. Some firms simply added AI strategy to presentations. Others announced ambitious but vague initiatives. Certain companies changed their name, replicating a pattern seen during the blockchain bubble, the internet bubble, and even the railway mania of the 1840s. But the most visible inflation occurred in the stock market. Nvidia became the fastest growing large cap stock in history, gaining over $2 trillion in market value in a single year. AI chip competitors followed. Cloud providers soared, semiconductor suppliers, cooling systems, power equipment, memory manufacturers, optical networking firms, every part of the supply chain inflated. Some of this is justified. AI training requires hardware, electricity, and infrastructure at a scale humanity has never built before. But valuations began rising faster than revenues. Companies with no meaningful AI product doubled or tripled in value solely because they could benefit from AI someday. This speculative halo effect mirrors past bubbles with surprising precision. In the dot-com era, companies with internet strategy saw valuations skyrocket without profits. In the 1920s radio bubble, firms added wireless to their name to attract investors. Today, AI-powered replaces wireless-enabled, crypto-integrated, or web-optimized. The economic data adds more fuel. Despite massive investment, AI has not yet produced broad productivity improvements at the macroeconomic level. Studies from the IMF, OECD, and leading research institutions all echo a similar theme. AI productivity gains are promising, but not yet visible at scale. While certain industries see early benefits, software development, marketing, customer support, others remain unchanged. Corporate spending reflects this uncertainty. Companies are allocating billions to AI integration, but few report significant revenue uplift. Even the largest players acknowledge that monetization is still developing. When the world's most powerful tech companies admit that profits are years away, while their valuations rise daily, the signs become hard to ignore. And yet, expectations continue climbing. Analysts publish forecasts predicting that AI will add $7 trillion to global GDP. Politicians promise AI-driven prosperity. Venture capitalists claim AI will replace entire professions. Every week brings new predictions about intelligence leaps, model breakthroughs, and economic revolutions. Many are plausible. Some are probable. But all contribute to a cultural narrative where AI becomes not just a technology, but a near mythological force. This is how bubbles form, not from fraud or delusion, but from the belief that progress will arrive faster than reality allows. Underneath the optimism, companies face a fundamental problem. AI is expensive. Not just to train, but to run. Inference costs remain enormous, especially at scale. Companies offering AI tools struggle to balance demand with profitability. Many operate at thin margins or even losses, subsidizing usage to attract market share. It echoes the early days of social media and cloud computing, except the cost curves are far steeper. Another factor fueling the bubble is competition. Nations see AI as a strategic asset on par with nuclear power. The United States and China now engage in one of the largest technological arms races in history. Governments pour billions into AI infrastructure, regulation, and research. This geopolitical pressure accelerates development, but it also inflates expectations beyond what technology can deliver today. Still, none of this diminishes AI's potential. It simply reveals a mismatch between present reality and future belief. The world is betting heavily on possibilities that may take a decade to materialize. In the meantime, valuations reflect visions rather than fundamentals. Every bubble breaks at the point where expectations exceed what the system can sustain. For the AI bubble, the breaking point may come from one of several fronts: compute shortages, profitability challenges, regulation, energy constraints, or a broader economic downturn that forces investors to reassess risk. It may not be dramatic. Bubbles rarely pop in a single day. They deflate slowly, quietly, and then suddenly all at once. One risk is consolidation. The AI ecosystem increasingly revolves around a small handful of companies that control the chips, the cloud infrastructure, and the frontier models. Concentration creates fragility. If any major player experiences delays, cost overruns, or technical setbacks, the ripple effects could freeze entire sectors. Another risk lies in the economics. Training costs rise every year. Energy consumption rises every year. Model complexity rises every year, but user willingness to pay does not. If costs grow faster than revenue, even the strongest companies feel the pressure. Investors will eventually demand profitability, and when that happens, the industry will face a reckoning. A third risk is regulatory. Governments worldwide are drafting rules that could reshape how AI is developed, trained, and deployed. Regulations on data usage, safety standards, copyright, and compute limits will all increase operational costs. Some regulations may be necessary, but the speed and scope of legislative action create new uncertainties for companies already operating on thin margins. But perhaps the most overlooked risk is psychological. Bubbles depend on belief. When belief weakens, momentum dissolves. The moment investors begin asking whether valuations reflect reality rather than optimism, the bubble begins to unwind. Not because the technology fails, but because the expectations surrounding it become unsustainable. Still, the end of a bubble is not the end of innovation. The dot-com crash eliminated thousands of companies, but the survivors, Amazon, Google, Apple, became the backbone of the modern world. The same will likely happen with AI. A contraction would strip away speculative excess, leaving behind the companies, ideas, and technologies capable of generating real long-term value. The AI revolution is real. The bubble around it is real too. These two truths do not cancel each other. They coexist. One represents the technology's potential, the other its economic environment. Understanding the difference is essential, because bubbles don't just distort markets, they distort expectations. And when expectations shift back toward reality, the world must adjust. But when the dust settles, AI will still be here, more powerful than before, more integrated into industries, and more essential to global competitiveness. The temporary inflation of expectations does nothing to reduce the long-term trajectory of the technology. This is the paradox of innovation-driven bubbles. They can break, yet the underlying transformation continues. Progress slows, consolidates, then accelerates again. The hype fades, the fundamentals remain, and a new cycle begins. And that cycle is already forming. As companies refocus on profitability, as researchers push for more efficient architectures, as governments invest in infrastructure rather than speculation, AI will shift from a narrative to a tool, from potential to productivity, from promise to impact. The bubble may burst, but the future it points to will still arrive. If you enjoyed this deep dive and want more long-form finance documentaries like this, make sure to like the video, comment your thoughts, and subscribe. Your engagement helps us reach more people and continue producing high-quality content every week.